Now, there is a famous saying out there, three words. It's actually just one word repeated: location, location, location. If you had a business and you were trying to figure out where to locate it, you should probably consider taxes. Shark Tank's Kevin O'Leary was shopping for a place to put his new data center, and he had to cross the state of New York. Well, he crossed it off his list.
The fine people of New York should ask themselves, why are we such a loser state? How are we going to attract business? It's not just the existing businesses that are fleeing out to Texas and Florida. What about new money like that I'm talking about, like a $4 billion data center? Not a chance I would put that in New York. Zero probability. Never.
Now, let's look bigger picture here. Let's think of your retirement as a business. From a tax perspective, retirement accounts are often the largest debt that an account owner has. Where you live and how to reduce those taxes, also important. How do you guys help out with that?
Well, I think his example of a business in the state of New York is a perfect example. I can think of at least two friends of mine that are financial advisors that used to live in New York. They both now live in the sunny state of Florida. So when you think about retirement accounts, you have to realize that retirement accounts are actually one of the biggest, if not the biggest debt that somebody owes. You know, if you had a business partner and that business partner, you owed a percentage of what your business was worth, and that business partner also had the right to say in the future that they deserve more, and you had little to no control of that, the question becomes, how fast would you want to get rid of and buy out that business partner? And, you know, retirement accounts are about the only account that I can think of that people choose to defer taxes to later in life. And the concern is if you're successful in investing, your account balance will grow to be a bigger value than it is today. In addition to that, because of the out-of-control spending that Washington has done, they've left us in this massive debt problem with unfunded liabilities like Medicare, Social Security, the prescription drug. Our national debt is now the highest it's ever been and continues to go higher and higher. So tax rates are, in my opinion, likely to be higher, especially for those that were successful in saving and investing into their future. So when you look at retirement accounts, and that's one of the things that we do in our retirement team action plan, is we look at taxes, estate planning, asset protection, and money management. And I would first say that we're not a CPA, we're not an accountant, we're not going to prepare people's taxes, but we're going to try to give you proactive advice by working with a CPA, working with a tax preparer to run the numbers. And before the end of the year gets here, because the clock is ticking, a lot of these things you want to implement, you know, before kind of year end. So when we're looking at retirement accounts, one of the things that a senior could do is they could consider relocating to a tax-free or tax-friendly state. You know, I love Northwest Ohio. I love the different seasons, but you know, to be honest, I probably like snow just on Christmas and maybe one other day. Other than that, the darkness at night and the extended downturn of the cold weather does make some of these tax-friendly states more attractive for folks in retirement. And that's why you see so many people that are moving to those states. Number two is looking at Roth conversions. So with a Roth conversion, what you're doing is you're taking the money in the traditional tax-deferred retirement account, you're paying taxes in today's dollars, and you're converting that over to what could be potentially a tax-free account, not only for you, but for the next generation as well. You want to look at tax-efficient withdrawal strategies. We've talked several different times about this particular topic. I had a gentleman who had come into our office last week, and this gentleman was looking at his withdrawal strategies. His wife was a little bit younger than him, so she is currently getting her health insurance from the Affordable Care Act. Well, they have a credit on their taxes based upon what they estimate their reportable income is going to be in the year 2024. You know, one of the things that I caution them is, hey, make sure you watch out what your thresholds are of your income, because if you go over a certain income level for affordable health care, when you file your taxes next year, they could ask for that money back. So again, a tax-efficient withdrawal strategy is a great idea in his particular situation. He may want to take more money out of his non-taxable retirement account and delay until his wife gets onto the Medicare age. What you want to do is you also want to fill up the tax brackets when you're looking at taking advantage of your situation. We have met with parents of our adult clients, and we look at the fact that they're forced to take required minimum distributions. And between that and Social Security, they oftentimes don't have much or any taxes that they owe. And then they have these large retirement balances that their desire is to pass that money on to the next generation, their children. Well, what they don't realize is that their children are not going to be able to inherit those retirement accounts in as a tax favorable way as what they could. What they may be better off doing now is taking advantage of the tax bracket that they're in, looking to pay some taxes now, especially if the desire is to move that money over in a legacy to the next generation by filling up those tax brackets. The other thing is for that older generation, for those of you that are over 70 and a half, and you're donating to a charity, make sure that you're aware of what some of the tax strategies are and what you can do with money over the age 70 and a half, and specifically talking about required minimum distributions. Oftentimes people will take the required minimum distributions. That's then going to be reportable taxable income on their tax return. They'll put the money in their checking and savings account, and then they'll write out a check to the charity. Well, it could be much more tax efficient if they wanted to donate to that charity, to donate directly from their IRA to the charity, thus keeping it off of their personal tax returns. Another area with end of the year coming up is looking at capital gains and tax loss harvesting. I had run into another situation for a gentleman quite a bit older, not the best health, and when I looked at his tax return, he had this large balance of a carry forward loss from an experience he had had in the past with some different investments that he worked with. And what I explained to him is I said, looking at your tax loss, you can only write off roughly $3,000 a year of that. But over here, you've got some of these other investments that have done really well. During your lifetime, you may not be able to write off all those losses. Instead, what you can do is you can take some of the gains to help accelerate getting rid of those carry forward losses. In addition to that, I have another client that we work with. We'll take a look at his portfolio, and every year we'll selectively pick out investments because he wants to try to get, some type of tax loss and be able to take advantage of that. For those of you that have non-retirement accounts, individual investment accounts, municipal bonds could be another category to take a look at. Now that interest rates are starting to change a little bit, bonds typically work inverse of interest rates. So as interest rates go down, bond prices can go up, and municipal bonds could be another way to get some tax-advantaged income in some of those tax-advantaged accounts. If Scott was here, I know he's busy during this time period with helping people with their Medicare, but one of the things that Scott would talk about would be health savings account. While you're still working, putting as much money into building up that health savings account, you're going to need it down the road for, helping some of the healthcare costs that you have when you move into retirement time, all the way down to helping protect your assets from long-term care. And the final ninth idea that I would have about looking to think of reducing taxes in retirement time, thinking of your retirement as a business, is Social Security optimization. So another lifetime income source that is important on when you take that income. Getting offered the ability to take the income early, but at a reduced rate, may not be the best decision. If you look at your business and look at your retirement as a business, the best decision would be, how do you get as much income as possible into the business for as long as it lasts?
Especially when you start approaching, a lot of people seem to be in a rush to turn on their Social Security at age 62. That's, you can look at each situation on a pro and a con basis, but once you get to your full retirement age, like for myself, that's 66 in 10 months. For a lot of other people, the full retirement age is 67. At that point, if you're still working, you can earn as much money as you want, and your Social Security benefits are not reduced. But if you are continuing to work, you'll find that more of your Social Security benefits will be income taxable. So does it make sense to take it early? Does it make sense to wait till full retirement age, or does it even make more sense to wait until age 70 when the benefit is maxed out? That's a main reason why you need to meet with us here at America's Retirement Headquarters to make a decision that's based on your individual circumstances and what makes the most sense for what your vision of your retirement is going to look like.
It's all encompassed in that retirement team action plan, taxes, estate planning, asset, money management. It's not just one of those things that's working for you or against you, but if you neglect one of them, it could make the whole thing fall apart. So start developing that strategy, especially as it pertains to, that business partner you have in Uncle Sam and buying him out as soon as possible. It all begins with the conversation. 419-794-3030. The website, arhq.com.